Good evening, everyone. This is George from GettingMarketMoney.com with today's Currency Corner edition, Tuesday, September the 14th. Okay, today was a busy day in the markets. S&P 500 tried to rally, and tried as it might, it did not succeed. It closed the day on a rather bearish note. As you can see, a resistance is starting to form at the 112. Now remember, this is the S&P 500 ETF. And we see a channel here forming. As you can see, this red circle shows bearish momentum. Although it is above the 250 EMA, the price action is reacting to this current level, and we believe it's going to find support and rally back down to at least the 100 as depicted by the 50 EMA. And at that point, it would also actually coincide with the 38 to 50% Fibonacci retracement. So the S&P 500 has been bullish. It has rallied just over 4% for the month. However, that I believe is about to turn. A recent strength is from short coverings. A lot of people were short. There were a lot of bears in the month of August, and those positions recovered, which led to a rally. But as well, there was optimism in the market. However, when the market is optimistic on low volume, as you can see here, that to me is an indication of a short-term trend. Remember, big moves happen on big volume. This was not the case. So I'm bearish on equities. Today, as you can see, the equity markets overall closed on a rather neutral note, we could say, and the Asian markets are currently up, but up only slightly, and the slightest of margin. Tomorrow's news releases, as you can see at the bottom, we have manufacturing, sales, Empire State, etc. They're listed. I'm just going to slide them up a bit so you can see everything. But before I do that, actually, I'll explain gold. Gold's up today to a record high of 1276.50, and that level broke out to the upside. There were many technical analysts, including myself, fearing that it would retrace deeply before that move. However, that move happened rather violently, as is the case with gold. Gold moves fast, violently, and if it's not in your favor, painfully. So it's up at 1276, currently 1271, and that was a massive jump, around $20 an ounce. Now this could be due to our risk aversion, the renewed risk on, risk off cycle. Currently at risk off, people seeking safer assets, ones that have actual value and are not fiat currency, as they say. That is, they can't be reproduced. That is one aspect of gold. The other, we're in October. October is seasonal strength for gold. If you graph a chart historically for the past 30 years, the largest percentage of the move is allocated in the month of October alone, and September. So September starts seasonally to strengthen, and it moves and carries on through the month of October. During those 2 months, it will gain the largest percentage of the movement during that year. So it's always good to keep that in mind. Seasonal strength is hard to ignore, especially when it holds true over the course of the past 30 years. So gold's been up. Oil is stable around 75 to 77. It's in a range, it's comfortable there. And although I am bearish on the equity markets, I could see gold holding ground above 75 for a while at the least, especially moving into a season of colder temperatures. So that being said, I'm just going to slide up the news releases for you. Not going to touch much on them. Have a look for your information and do with it as you please. Today we had retail sales come out. Nothing extraordinary. It was a little bit better, but again, was overshadowed by other events. Also, as some of you may have heard, the Basel agreements that have been released for companies to raise their Tier 1 common equity to 7% with 4.5% minimum and 2.5% capital conservation buffer. So that's over a phase of the next 7 to 8 years. To me, that's a sign of extreme ease on the banks. I mean, I was expecting a high percentage, 7 to 8%. 8% is in the neighborhood of what the street was looking for but over 7 to 8 years, that is a little bit ridiculous if you ask me, but nobody does. And so that's just how the cookie crumbles, I suppose. So the Canadian banks, however, already are close to that ratio. They're fine. The ones in the US are the ones that may come into some challenges for raising that capital. Most investors were looking for a shorter time frame for it to be raised at 7% and expecting shares to be issued, which could cause dilution and other problems. Didn't happen. The banks are giving some time. Capitalists see that as a positive aspect. Myself, I would prefer to have seen a raise to 7% in a lesser time frame. We really don't have time to get into too much details. It's a session on its own. That is the case. Let's look into some currencies for the day. Euro USD shot up quite a bit the past 2 days, and the euro is strong, although this jump, I believe, is just due to the short-term economic news. I actually see the trend as being down, and there is speculation and renewed worries about the European Union. The stimulus package was a bit too small for their needs, is the typical consensus out there. However, the market is up, go figure, but the traders are actually moving their positions from, as shown on the Commitment of Traders report. You can find that online. Into Google, type in COT or Commitment of Traders, you'll get the numbers. You'll see a lot of the contracts are moving in favor of a weaker euro and stronger US dollar. That being said, the chart has been up. It's broken some resistance levels, so in this situation I would say stay on the sidelines for the Euro USD, but the overall trend is down. Look for a weaker euro, stronger US dollar. If you wanted to put in a speculative position, I would cap it and maybe limit your risk to around this level. So I'll just change the color here. Around this level. If you're going to do anything, put a stop loss there. If it breaks above this, we'll definitely see the 200 EMA, or 100 EMA rather, sorry, at 131.77. So if it breaks that level, you should be getting stopped out and waiting for a higher price to get short and get in on the trend. Ideally, I see us back to 123 to finish the year, but that will take some time to develop and materialize. Moving on to the next currency pair, USD Japanese Yen. We talked about it yesterday. I said not to short it. Hopefully you didn't. If you did, you got hit with 100 and some odd pip loss, and that was an extremely risky point down at this low. 15-year low to be shorting is unacceptable as a trader. You shouldn't be selling the lows or buying the tops. In fact, it should be the opposite. So hopefully you didn't get in on that. That being said, many will argue the point that it could be a good time to add a position at this point. I would not myself. However, the argument can be presented in favor of a short. If you want to keep the risk minimal, as Bank of Japan has openly said, anything below 84, the government may intervene and buy US dollars and sell yen on the open market to raise the price up artificially. That will be a short-lived moment. If the government does come in the market and intervene, you could expect to see a violent rally to the top, but the wise traders will sell into that and won't be sustained. So we're going to keep a very close eye on this currency pair over the next days, and we're going to get some signals here to trade and lock in some profits. Currently though, it's a very risky place to be putting any orders on the market, as we are at levels that will be a change of bias. Essentially at these levels, to the upside will be bullish, to the downside will be bearish. But as said, for the moment, it's not the right time to be putting a trade on the currency markets. Keep that money safe. It's better to not trade than lose. That is the lesson of the day, and we'll wrap it up here. Have yourselves a great trading day tomorrow. We look forward to hearing from you. If you have any questions, George@gettingmarketmoney.com. If not, we'll touch base tomorrow with the Currency Corner edition for the Wednesday. So, everyone have a great evening, have a great trading day. This is George from GettingMarketMoney.com. Don't forget to drop by the website, sign up, share your opinion, comment, post your own analysis. It's encouraged. Alright, have a great one. Take care.